As a stacker, you have to wonder sometimes, how does the United States government actually create money to fund a stimulus program? Because we're in the middle of talks for stimulus. By the time this video comes out, maybe there will be stimulus, maybe there won't be stimulus. Who knows? But how do they fund the stimulus? Well, let's find out. So the United States government has this tool that's called stimulus, which is basically injecting money into the government. But you have to understand that the Federal Reserve cannot just print money and dump it into the economy. Yes, I believe it is illegal for them to do that. However, how they do stimulus is actually not just the Federal Reserve. They need to go through the Treasury. Now, the United States of Treasury, it has a few options, right? It can try and print money. Like the Treasury and the Mint can actually physically make money. When we buy American Eagles, that's the United States Treasury and Mint. They actually make money. It's not the Federal Reserve that makes that silver eagle. But the Federal Reserve can also increase the supply of money. You're like, how the hell do they do that? Well, it's kind of like they use magic money, essentially. To make it short, if you don't want to listen to the whole thing, is that the short version is that they really just make magic money. But the real mechanism behind how they make magic money is that the United States Treasury emits bonds, right? In the last stimulus package we got, there was around $2 trillion. It didn't have to print $2 trillion worth of bills to pay for stimulus. What it just did was it emitted bonds. And these bonds are bought by the Federal Reserve. But the question is, what does the Federal Reserve buy with, right? The Federal Reserve can't exactly print money. Well, the Federal Reserve emits digital dollars. You're like, huh? What? We have a digital dollar? Yeah. The Federal Reserve essentially makes an electronic transaction with the Treasury, and the Treasury has its bank account, which is electronic. All our bank accounts are electronic. We are all using, on a day-to-day basis, we're using electronic money. That's why some of the stackers out there, they're telling you, yeah, you might want to stack some notes because everything is electronic. So it's a computer system that holds a unit. And basically, if you wipe the memory of the computers or enough computers, basically you wipe the fact that your account has money. But of course, normally they do have a paper trail somewhere in the bank to say that they owe you money. But it's kind of scary to think that but they used to do that. Nowadays, I'm not so sure they keep a paper trail, but it's kind of scary to think that if some of the banking systems fail, like the computers and so on, and these computer systems are built back in the 80s, 90s, they run on legacy programs. I've worked on some systems. They run on really, really old legacy programs, and it's kind of horrible. That they can fail any moment. Anyways, yeah, so if you are a stacker, maybe also consider to get some paper notes just in case you might need some cash on hand and somebody wipes the notes off the accounts. But essentially, the Federal Reserve makes magical money called digital dollars, and they deposit it in the Treasury, and the Treasury is funded now. So how does that work actually? Why do they go through this process of buying bonds? And why is it what type of impact does it really have for the overall economy and the overall market? Well, to understand that, you have to understand a little bit of how bonds work. When you get a bond, basically you pay a price, right? And then every single payment, you get something called a coupon, like kind of like a scratch card, and you break off your coupon, you tear off it from your bond, and you go to the treasury, and then they will give you money in exchange for it, like normally cash. That's essentially how it works. That's how it used to work in the old days. Nowadays, you have your bond and then it's automatically removed. There's a whole system behind it, and brokerages will automatically credit you with electronic dollars. But here's the thing. In a normal functioning, let's say bond market, right? Normally, let's say the treasury emits a bond, there's an auction, and people take into consideration something called inflation. And they take a look at the inflation at the maturity, and they determine what will be the real yield. In this case, for a basic coupon that pays $11 per coupon over 10 years, it will yield $110 at maturity with the total amount. If you have a 2% inflation, the real yield at the end is roughly 1.86%, right? Now, if you have $100, right, the prices increase, you increase it by $3. The yield rate at maturity is 110. You believe the rate is to be 10, this is a coupon rate is 10%. You've increased the price from the $97 to the $100 by 3%, a bit over 3%. But what happens is it actually decreases the yield, because since you're paying more in the beginning, essentially when you subtract what you pay for versus what you got at the very end, it's much less. That's the basis of the story. And if you add in the fact that you get inflation, the total amount you get less, $110 inflation adjusted over the course of every single year. Now, I assume a best case scenario where every single time you get that cash, either you've spent it on things you need, or you've, wait a second, there's a mistake there. That is, sorry. Yeah, you spend it on things you needed, or you put it into inflation protected assets, such as gold, silver, and basically you've held on to it. Even in that best case scenario, your real yield is negative. I'm looking at here, your yield is $110 based upon the initial price of $100. That's kind of like, you're like, oh yeah, that's a 10% rate, and the return over 10 years is not so bad. But actually taking into consideration the 2% inflation rate, it absolutely destroys it. It just like destroys your real yield. Now, think about it like this. If the Federal Reserve, right, there's an auction, and the Federal Reserve says, okay, there are these coupons. Let's imagine the coupons are $11 per. You get one coupon every year, and you can redeem $11. And this bond is emitted. The Federal Reserve goes, okay, we're going to set the real rate, right, the rate here, at per coupon at 0.35%. And you're like, okay, if in normal market situation, people want a little bit of interest, let's say here it's like 1.86% real interest rate when adjusted for inflation. Now the Federal Reserve comes and steps in, and they hike up the price to give you this specific rate of 0.35%. And they're like, okay, and we're doing this to inject cash, but also we know banks will lend people based upon our set rate. And you're like, okay, what does that mean for in real terms, in terms of if you're an investor investing into bonds? Well, pretty much you don't want to invest into bonds, because first of all, the bonds are quite expensive in this case. They've increased in almost 9% in price compared to the 100 one, and almost 13% compared to, let's say, a market priced bond. So essentially what might happen is everybody here will sell to the Federal Reserve. It just squeezes the market, and the Federal Reserve has to buy a ton of bonds, right? And if you're a bondholder, you have zero interest of holding your bond, because basically you can get a payout right now, and you don't have to worry too much and you'll get more than if you keep it in the bond market. And basically what happens afterwards is, okay, the new rate, the coupons haven't changed, but the initial price has changed. It means that the new rate is 0.35%. We've seen a massive price increase of 13%, but in terms of real yields, it's horrible. If you have inflation and this is the actual interest rate, that means 0.35%, you're looking at almost a minus 10% real yield decrease if if that's the case. And you're like, wow. So it's actually not like, it's not just like you're losing 2% inflation. I mean, if over the course of 10 years, if 2% inflation, and you have a very low rate, you are looking at like quite a extremely low yield and return. Basically, you're losing money. You're like losing 10% of your money. You'll lose less than if you just kept it as cash, but you're still losing money. If you kept it as cash, you multiply this by 10, you'll lose like 18%. Okay, 11, you lost like half of it. It's not as bad, but it's not great either. And if you go into negative territory, you're going to lose even more. You're losing almost, 30% of your money over the course of a few years. In normal circumstances, in the normal bond market, essentially bond market works in the normal market as an inflation protected asset. Meaning normally people don't buy bonds below what the real yield when taking into consideration inflation. It's just dumb to buy bonds at too high of a price. But the Federal Reserve does not care about the price. It's using this as a quantitative easing tool. Now you're like, okay, what does that mean for the price of gold? Well, it means that gold has a few competitors. Gold and silver have a few competitors. And one of those competitors is bonds. The other one is the stock market, right? If bonds are completely destroyed, that means as a wealth preservation tool, because the Federal Reserve needs to use it for monetary policy and quantitative easing, what happens is if you are a private investor or a private institution who is looking at just diversifying your portfolio, and of course part of your portfolio will be stocks, most likely, but part of it will also be these type of asset safe products. You don't really have much of an option. You're stuck with either really terrible yields, and you will lose 30% of your money by investing into it, or potentially you could choose to buy gold. Now, there's another part which I haven't mentioned, is that right now the Federal Reserve is keeping it at 0.35, right? And your yield you're losing 10%. But if, let's say the Federal Reserve stops QE and they start selling, this is the Federal Reserve's idea of quantitative easing, is that they want to do it through the bonds market because they have assets, and eventually they can sell the bonds. But imagine you are an investor and you decide to buy bonds now, and you bought bonds at the low rate of 0.35, and your real yield is negative. You're like, okay, it's not too bad. But what if tomorrow the Federal Reserve decides that, okay, we need to tighten monetary policy, we're going to sell bonds, and they flood the market with bonds, and the market over time returns to normal to 0.97. You would have lost, in addition to having lost your yields, like over 10%, the actual price of your bond also decreases. This is the thing. So you are getting hit by a double whammy. So you really don't have an exit at that point. And that's why it's a terrible thing to buy, I would say, bonds that don't beat inflation in terms of returns. So it absolutely has no point to exist, other than, it's kind of a vehicle for investment, I guess, or for holding money for central banks, or for adding liquidity into the market for central banks. At this point, unless you're a central bank looking to inject more money, or reduce your monetary supply or your dollar supply, it doesn't make sense to use bonds. Actually, it's pretty terrible. So what might happen, I think this is what most likely will happen, is now this is, I don't suggest you go and trade off what I'm going to say. I don't suggest you go all in on the market based on what I say, or even buy anything based on what I say. I'm not a financial advisor. What I think might happen in the near future is that precious metals and commodities will fulfill the role of bonds in portfolios. Right now, they don't. They are more, I would say, people consider them as second tier assets relative to bonds, or what bonds were. So potentially they'll become first tier assets relative to bonds, so gold and silver. And silver will take on more of a monetary role in the midterm to long term, as long as central banks use bonds as a tool for monetary policy. And stocks still keep their role as stocks. They're not really competitors. Like the stock market and gold are not competitors in terms of competing for portfolio investments, because they really do relatively different things, and one is much more volatile than the other. And the stocks basically is much more volatile than gold. Gold has a lot of hedges, like different directions going for it and against it, especially relative to the US dollar and the US stock market, also against certain emerging markets. I think what might happen is people will cycle between stocks, gold, mainly gold, some silver, and also emerging markets, and especially emerging market bonds, which tend to have much better yield compared to U.S. bonds. I believe the Chinese bonds is around 3%, so real yield, but also they have a quite high inflation. So you have to do the math and see if it's actually worth it for you to buy some of these emerging market bonds. It might make sense if their exchange rate is favorable. Let's say their exchange rate is currently their currency is cheap. If you buy their currency and then the value of the currency increases, and you're trading in one currency, it could actually be beneficial. But you don't know which direction currencies will go either. So yeah, that's a big question. So now you know why, if the central banks do QE and decide, when we have stimulus, let's say even if it's 7 billion, they'll have to fund it. They'll have to buy off the market bonds to finance the treasury, and the treasury will basically use that money to finance the programs. And in that process, they're going to kill off an investment vehicle, which means that pretty much that money will have to will either sell off their positions in bonds to the Federal Reserve, and so the Federal Reserve emits more money into the open market, and then basically what happens is those people who sold their bonds, now they're going to be able to buy gold and silver and other assets, and it pushes the price up. In theory, that's what it should do. However, it doesn't. We don't know. Most likely, I don't know. I don't have a crystal ball, like I always say. Anyways, now you know how bonds work and how they can affect the gold and silver market. If you like the video, click the like button. If it helps me out a lot. If you're not yet subscribed, please subscribe to the channel and click the bell notification button. Thank you for watching. Dave out.